Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered.
Thank you for tuning in to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I'm Virginia Lucci, and I'm your host for this afternoon, coming at you live from my house in lovely, beautiful, hot, and humid Montgomery, Alabama. Today, we'll be covering your Wall Street Week in Review, earnings season for our 5 favorite banks, the future of pharmaceutical stocks and coronavirus immunizations, and stick around for the end of the show where I'll give you my top 10 personal finance apps. As always, we're going to start with a Wall Street Weekly Roundup for the week of July 12th through the 17th. As the second quarter draws to a close, it's the opening of earnings season. Overall, stocks continue to look for direction as we're still opening and looking for a vaccine. The good news is that Wall Street ticked higher this Friday to close out its third straight winning week. But the bad news is that we're not achieving steady gains. Contributing to the market's volatility this week were reports showing a strengthening in the U.S. home building activity. As an aside, I can personally attest to this because they're building an entirely new subdivision right behind our house. I'm working from home these days, and the construction noises are driving me crazy. Friday afternoon, as a little help to me, my puppy decided that she was going to start barking at the construction noises. So all I can say is thank goodness for noise-canceling headphones. On the other hand, the reason why I'm working from home is because of the coronavirus pandemic. The virus continues to spread, so recovery is really not going according to the initial planned pace. We need to add more aid to the U.S. economy. According to the Wall Street Journal, the next aid package will be critical for shaping the pace of the recovery. Well, we don't quite know which way the Trump administration is going to go with this. We know who the major players will be. Lawmakers are returning from recess Monday and have a limited time to work on a bill before the August break. So it's likely that Speaker Nancy Pelosi, Fed Chairman Jerome Powell, will work with Treasury Secretary Steven Mnuchin and Trump advisor Larry Kudlow to craft a bill to bring to the Senate. According to Kudlow, the administration will be backing a temporary suspension of the payroll tax, which will give workers a 14.3% increase in their paychecks, in their bring-home pay. I'm not sure if this is going to pass through the Senate yet, because at this time a Republican plan does not exist. A federal $600 a week boost to regular unemployment benefits expires at the end of this month. So too does the federal ban on evictions on millions of rental properties. This is a really big deal. We've had 17 straight weeks of unemployment claims topping at 1 million, where it's usually only about 200,000. So many households are facing a cash crunch, and they're going to be losing their employer-based health coverage. So, despite a few flickers of an economic upswing as states eased their stay-at-home orders in May and June, the jobless rate remains in double digits, and it's higher than it ever was during the last decade's Great Recession. It's likely that the Trump administration is going to continue the $600 extra benefits for laid-off workers. It's important for both Republicans and Democrats to have a strong incentive to agree on a pre-election stimulus. It shouldn't be a matter of if something passes, just when and what it's going to look like. On Wall Street this week, the S&P 500 rose to 9.6 points to 3,224.73. It's rallied back to within 4.8% of its record set in February and bounced back to where it was in early June. So that's good. Nearly 3 in 5 stocks rose. In tech stocks, though, the NASDAQ struggled. It dropped 1.1%. It reversed sharply from a record high on Monday. The tech-heavy NASDAQ never closed below its 10-day line and finished right in the middle of its weekly range. But investors were selling off some high-flying companies, including Microsoft Corp, Amazon.com, and moved into cyclical sectors. So that's not great news, but our rock star of the week is the Dow Jones. It's up 2.3% this week, outpacing both the S&P 500 and the NASDAQ, obviously. So with that said, I want to bring you our winners and losers of the week. Our first winner is BlackRock Corp. Their stock rose 3.7% for one of the largest gains in the S&P. It beat profit expectations as investors leaned on its bond funds to make new bets in a volatile market upset by the pandemic. Bonds are usually pretty safe, so this was a good bet. The second winner of the week is J.B. Hunt Transportation. Their stock rose 3.2% to a 52-week high following strong beats for the second quarter earnings. Because truckload capacity has decreased and stricter social distancing requirements are being enforced, it puts a heavier burden on J.B. Hunt's drivers. So, when you can, thank a truck driver. Our biggest loser of the week is Netflix. Netflix dropped 6.5% for the largest loss in the S&P. Netflix obviously was one of the biggest beneficiaries of lockdown measures worldwide. But it shaded investors' optimism when it said Thursday that subscriber growth may slow for the rest of the year. I guess since everyone's already seen Tiger King, people aren't just that interested in Netflix anymore. Other markets held fairly steady this week. In the bond market, the yield on the 10-year Treasury rose slightly from 6.1% to 6.28%. Not surprisingly, the yields rise as the bond prices fall. So this is a good time to get into some bonds. Commodities. Gold for delivery in August rose $9.70 to $1,810 per ounce. Oil for delivery in August slipped 16 cents to settle at $40.59 per barrel, and crude oil fell 24 cents to $43.14 per barrel. So, since we are at the beginning of the third quarter, it is my favorite time of the financial year. It's the earnings season. Right now, the new earning reports are going to be coming out Sunday evening at 6 p.m. Eastern. Here's what I would like for you to watch for. The first one I think is of interest is IBM. IBM is the first major player in the cloud to report. So cloud names generally have rallied sharply from March lows on the belief that the coronavirus pandemic will accelerate adoption, which I can see in my own daily life as I'm sharing files to the cloud on a daily basis. Amazon, for instance, no doubt benefited from the e-commerce tailwinds, but Amazon Web Services is likely a driver. So their cloud-based services are one of their best commodities right now. The second reason that IBM's release is worth watching is precisely because of its multi-year history of disappointment. So IBM isn't the corporate giant it used to be, and this market has not been kind to value stocks or turnarounds, and growth stocks again have led their way since March. We'll see in the post-earnings reaction if there's any sign of a change in investor attitudes. Second stock I want you to watch out for is Coca-Cola. Coca-Cola is set to release their findings on Tuesday the 21st before the market opens. Coca-Cola may be the best barometer of the recovery. After all, few companies will better understand precisely how consumers are acting across the global market at this very moment. Coke should have real-time commentary on restaurant demand and provide an update on the grocery channel as well. So be sure to keep your eye out to see what Coke is doing. Number 3 is going to be Microsoft. Microsoft earnings are out late Wednesday. Wall Street expect Microsoft earnings to rise 1% to $1.38 a share, with revenue up 8% to $36.49 billion. Cloud computing services and other cloud revenue likely will drive Microsoft gains once again. Number 4 is Snap. Snap and Twitter. Snap's report will be out on Tuesday, July 21st, and Twitter will be out on Thursday morning. For both companies, this report is going to be important, if not outright crucial. The pandemic has accelerated usage, which, again, I can personally attest to because I have to see what's trending on Twitter at least 5 times a day. But this increased usage has pressured advertising demand and rates. So we don't really know what the net effect is going to be until next week. Number 5 to watch is Tesla. Tesla may make it into the S&P 500 if their second quarter reports look good. But unfortunately for them, they have even more competition in the electric vehicle world, with Volkswagen and Ford due to release electronic models of their vehicles. Number 6 is going to be AT&T. They're expected to release on Thursday, July 23rd before the market opens. So AT&T has been through some stuff over the last couple years. The pandemic interrupted a long-awaited rally in AT&T stock, which in November had moved to its highest level in almost 2 years. Back at $30, the second quarter earnings on Tuesday are going to give AT&T a chance to try and reignite their spark. But it's going to be really tough. I don't think the problem is going to be in wireless, but it's going to be in their 2 big acquisitions of the decade, DirecTV and Time Warner. Cord cutters are pressuring satellite companies and satellite subscriptions because it's a lot easier to subscribe to Hulu Plus than it is to get a satellite. It also is crimping the affiliate fees for Turner networks. And given AT&T's massive debt, those pressures are amplified in their stock price. It's not likely that AT&T numbers are going to show some surprising strength in their business. Rather, AT&T is going to have to convince investors it can be reactive. The most obvious way would be through strong numbers for the new HBO Max streaming service, but an early rebranding suggests that subscriber numbers likely have disappointed out the gate. I'm not really a fan of HBO Max, and I guess having friends on your platform is not going to make a streaming subscription service. Number 7 is Intel. The Intel earning is due late Thursday. Analysts expect Intel earnings per share to rise 4% to $1.10 a share, with revenue climbing 12% to $18.51 billion. Still, the PC and server chip giant will provide insight into the overall health of the semiconductor industry. They may be taking a significant blow from Apple's new conductor without Intel. But look to Texas Instruments, Skyworks Solution, and Teradyne, who are also reporting this week. Intel's Mobileye unit is going to be a big player in driver assist systems, so they've expanded. Number 8 is one of my personal favorites. It's Chipotle. Chipotle earnings are due after Wednesday's close. Analysts see their earnings tumbling 94% to 22 cents a share, with revenue down 9% to $1.31 billion. When indoor seating was shut down in most of the country for much of the second quarter and restrictions returning in recent weeks, digital sales have surged during the coronavirus pandemic, and the company is rolling out more drive-through Chipotlanes, which I think is adorable. If we're honest, though, I've probably had more Chipotle since the pandemic started than I did before, because it's super easy to go and get your burrito already made for you. So I don't count them out yet. Chipotle stock rose 1.6% to 1,136.22 last week. That's technically still in range from a 1,087.10 buy point from a flat base, according to MarketSmith and analysts. But investors should be cautious about making buys heading into earnings. Chipotle stocks may be buyable after earnings if it clears the little consolidation above the flat base, but we're not sure. We're going to take a short break, and when we come back, we're going to take a deeper dive into the big banks' earnings report and what went right and what went wrong.
Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered.
And we're back. Good news, everybody. It's reporting season. And we're going to find out just how our favorite big banks did. We've already gone over what to look for next week. So let's take a look back at what happened last week. The big banks released their reports to mixed reviews. JP Morgan Chase, Morgan Stanley, Goldman Sachs, and Citigroup beat analyst expectations on strong trading and investment banking results, while Wells Fargo posted its first loss since the financial crisis on loan loss reserves. The most successful banks have set aside billions to cover loans potentially going bad because of the recession. So the common theme we're going to see here is that preparation is the key. So we're going to start off with JP Morgan. JPM's earnings season opener is telling us that their business isn't bad. They say the calendar's second quarter revenue grew almost 15%. Earnings per share topped $1.38 and beat consensus by a quarter. JP Morgan is killing it because they've made provisions for the expected credit losses. The company was expected to increase reserves by nearly 10% on a quarter-to-quarter basis and far exceed those expectations. Credit reserves grew more than 26% to $10.47 billion. $10.47 billion, putting the bank's cash position on their best fortune for years. According to CEO Jamie Dimon, They earned $4.7 billion in income in the second quarter, despite building reserves of credit, $8.9 billion of credit reserves, because they generated their highest quarterly revenue ever, attributing this to their diversified global business model. So JP Morgan's dividend was attractive enough before the second quarter results were released, but now there's an interesting new twist that may dampen expectations. The first thing came from the Fed. The Fed put a cap on dividends and buybacks, forcing the big banks to reserve capital in the second and third quarters of this financial year. The Fed says that the banks like JP Morgan, will have to resubmit capital plans later this year, plans that could impact for future dividend payments. So we really don't know. It's still pretty volatile. The second came from JP Morgan itself. CEO Jamie Dimon said the bank wouldn't resume buybacks until actual economic progress was made, despite what the Fed said. He went on to say that the bank was able to pay its current dividend, yielding about 3.7% without issues, and he believes this will go on for many quarters to come. Dimon qualified his comment, saying the dividend cut may come if the situation is warranted, but it's really not looking to do that right now. So overall, this is good news for investors. They can assume their dividend is safe. At 3.7%, the yield is really attractive and almost a borderline high yield. Future increases and or buybacks may not come this year, but it looks like capital returns will increase in the near future. The payout ratio is fairly low, in the mid 60% range before the second quarter release, and now it's lower and likely to get even lower in the coming quarters. Assuming credit losses are less than expected, or there are more than enough provisions to cover them, a future distribution increase could be substantial. Morgan Stanley is our second big bank, and Morgan Stanley posted second quarter results that actually blew past analysis estimates on stronger than expected trade revenue. Like JPM, they had a significant decline in their net income. Still, the bank generated a record profit of $3.2 billion, or $1.96 per share, including an 8-cent per share expenses tied to taxes, which far exceeds the estimate of $1.12. Revenue climbed roughly 30% to a record $13.4 billion, a surprise increase that exceeded expectations by a full $3 billion. Shares of the bank rose 3.1%. So what's the secret of their success? Morgan Stanley is essentially a global investment bank paired with a large wealth management business. They benefited from one of Wall Street's best trading quarters in years because the New York-based bank runs the biggest stock trading business in the world, as well as a bond trading division that punches well above its weight. Wealth management generated a surprise 6% increase in second quarter revenue to $4.68 billion, fueled by an uptick in transaction fees. Wealth management is always something that you need to watch during an economic downturn. Investment banking as well climbed 39% to $2.05 billion, fueled by a boom in debt and equity insurance. Again, in an economic downturn, always look to your equity insurance. Under Chief Executive Officer James Gorman, Morgan Stanley has emphasized its wealth management division to provide a steady and growing source of revenue. He doubled down on that with the acquisition of E-Trade, a deal that's going to close in the fourth quarter. Our decade-long business transformation was intended to provide stability during times of serious stress, the CEO said. The second quarter tested the model, and we performed exceedingly well, delivering record results. So I think it's fair to say that Morgan Stanley's pretty proud of how they've handled this pandemic. Morgan Stanley hopes that they can continue to put many billions of dollars in excess capital to use, eventually increasing the firm's dividend and resuming share buybacks. Again, the industry suspended the buybacks in March, and most banks have maintained their dividend levels after the Federal Reserve stress test. So let's continue to hope good things come for Morgan Stanley. Our third bank we're going to review today is Goldman Sachs. Goldman Sachs said it generated $2.42 billion in profit, or $6.26 a share, crushing the $3.78 a share estimate of analysts surveyed by Refinitiv. This is their biggest earnings outperformance in nearly a decade. Goldman is really doing this right. Their shares jumped more than 4.1% on Wednesday after earning estimates were released. Revenue of $13.3 billion was higher than the $3.5 million was more than $3.5 million higher than the estimate, fueled by strong results in its trading and investment banking divisions. Bond trading revenue surged almost 150% to $4.2 billion, and equities trading revenues rose 46% to $2.94 billion. Together, the trading division produced roughly $2.5 billion more than expected. While the economic outlook remains uncertain, Goldman is confident that they will continue to be the firm of choice for clients around the world, as according to CEO David Solomon. Of the 5 banks that we're looking at today, Goldman gets the largest share of its revenue from Wall Street activities, including trading and investment banking. Something that we've already really seen work at Morgan Stanley. Now, with retail banks setting aside billions of dollars for loan losses tied to the pandemic, Goldman's model, I think, is going to have a real advantage. The pandemic caused surging volatility across asset classes starting in March, conditions that spurred institutional investors to place bet or hedge against losses. The Federal Reserve's unprecedented actions to prop up credit markets helped bond trading as well and opened up debt markets for even riskier corporations to sell bonds and issue equity at a furious pace, leading to record investment banking fees. 3 of Goldman's 4 main divisions produced more second quarter revenue than a year earlier. This is amazing. The bank added $1.6 billion to its loan loss reserves over the period as credit health soured. This is where they're smart. The buildup led to their quarterly profit to fall from a year ago, but investors looked through the smaller than expected profit slump and focused on their strong revenues across the trading operations. The key to this bank is diversity and participation in trading. Next, we turn to Citigroup. Citigroup had more good news. They announced their second quarter earnings on Tuesday, and they also beat analyst expectations for revenue and profit. They offset a showdown in the consumer banking division. Like J.P. Morgan and Morgan Stanley, Citigroup's earnings plummeted in the second quarter. Their net income was 73% lower on the year, driven by a substantially higher allowance for credit loss reserves due to the pandemic recession. However, revenue increased 5% from a year ago, reflecting higher revenues in fixed income markets and investment banking. Citigroup's fixed income trading revenue represents a 68% year-over-year surge and accounted for most of the company's markets and security services revenues, which rose 48% to $6.9 billion. Those elevated trading numbers come amid heightened market volatility during the coronavirus pandemic. They also come on the heels of massive monetary stimulus from the Federal Reserve. Equity trading revenue dipped 3% to $770 million, however. So, again, we're not seeing anything different that happened to Citibank than we saw happen to JPM or Morgan Stanley. Citigroup's global consumer banking division struggled during the second quarter, with revenues falling 10% to $7.3 billion on a year-over-year basis. Net credit losses, however, jumped 12% year-over-year to $2.2 billion. Ultimately, the company posted a net income of $1.32 billion, which represents a 73% drop from the second quarter of 2019. While credit costs weighed down their net income, their overall business performance was strong during that quarter, and they've been able to navigate the COVID-19 pandemic reasonably well. The institutional clients group had an exceptional quarter, marked by an increase in fixed income of 68%, according to CEO Michael Corbat in his earnings statement. They continued a sharp emphasis on risk management and were prepared for a variety of scenarios, and they'll continue to operate their institution prudently, given the unprecedented situation, because nobody knows what's going to happen from day to day. Citigroup shares are up nearly 12% in the last 3 months, so this is good. They are well outperforming their peers. So now we're going to go with the bad news. The bad news is that Wells Fargo fared the worst during the second quarter. They just cut its dividends, and shares are moving higher too. They were really not prepared for the pandemic to continue, but they may make a comeback for the third quarter. Wells Fargo reported weak results for the second quarter. The bank had a net loss of $2.4 billion in the second quarter, or a loss of 66 cents a share. Worse than the 20 cents a share loss predicted by analysts at Refinitiv. Revenue of $17.8 billion was also weaker than analysts' $18.4 billion estimate. According to the CEO, Charlie Scharf, they are extremely disappointed in both their second quarter results and their intent to reduce the dividend. Their view of the length and severity of the economic downturn has deteriorated considerably from the assumptions used last quarter, which drove the $8.4 billion addition to our credit loss reserve in the second quarter. So basically what they're saying is that Wells Fargo was not equipped to continue for the virus to continue. Shares of the bank fell 5% in New York trading after falling as much as 8% earlier. But things may be looking better for the remainder of the year. And with an 80% cut on Tuesday as part of their second quarter results, we think Wells Fargo management was issuing a warning as much as they were issuing a quarterly report. So I don't really want to say that this cut was unanticipated because everybody kind of saw it coming. But investors were really not expecting this to come in July when other banks were faring so well. So why is Wells Fargo struggling? First, Wells Fargo does not have a trading business that's comparable in size to that of the other banks we've talked about. This set Wells Fargo back quite a bit as the volatility in financial markets resulted in a greater trading environment. So Wells Fargo was really not able to profit from the volatility in the same way the other banks were. To some degree, the weaker performance of Wells Fargo can be explained by differences in their respective business model, as Wells Fargo's more lending center focus did really not pay off during these times. Another factor that plays a role in Wells Fargo's weak profitability was that the company did not benefit from the PPP loans to the same degree that the other banks did. Of course, Wells Fargo processed loans just like its peers, but unlike JP Morgan and Citi, Wells Fargo did not keep the profits. The most important factor for their disappointing second quarter was Wells Fargo's decision regarding its provisions for loan losses. The company reported provisions for loan losses of $9.5 billion during the second quarter, whereas JP Morgan added $8.8 billion. This comes despite the fact that Wells Fargo has the smallest asset base among these banks. Wells Fargo was then more conservative with its provisions compared to its peers. so it doesn't have the economic strength of its peers. Wells Fargo is also struggling to adjust to a lower interest rate environment. The bank's net interest margin, a key measure of a bank's profitability, plunged by 33 basis points from the prior quarter to 2.25%, below estimates of 2.33%. The current valuation could make Wells Fargo a solid long-term investment, even though investors should not assume that Wells Fargo is a riskless pick. My overall thoughts are that preparation is the key. The pandemic has really pulled back the curtains on how solid these banks really are. Everyone obviously suffered from a reduced revenue, but those who are more diversified, had a bigger base, were much better able to withstand the storm. We're going to take another break here, and when we return, we're going to be looking at key pharmaceutical stocks and their attempts to come up with a coronavirus vaccine. Stay tuned until the end, where I'll give you my top 10 personal finance apps.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand.
As we've seen, the big banks have had to make provisions to do business during the pandemic. Nothing has gone the way we thought it would. We may not have a football season. Baseball is barely back. And I just really don't want to live in a world without sports. But seriously, I mean, this is a really bad pandemic. People are dying, and we need to come up with some way to get people better. As more and more states are reporting an increase in coronavirus cases, Wall Street is really looking at the pharmaceutical industry for an indication of just how long we're going to have to work with this. Coronavirus cases worldwide are at 14.33 million. Coronavirus deaths have reached nearly 602,000. That's 602,000 people who've lost their lives to this deadly virus. Coronavirus cases in the U.S. alone have topped 3.81 million, with deaths over 142,000 as of the time that I'm recording this. On Friday, the U.S. added a record almost 75,000 new cases in one day. Coronavirus deaths in the U.S. have turned higher over the past week or so. The good news is that there are signs that hospitalizations have peaked in at least two of the hotspots of Houston and Phoenix, Arizona. The Trump administration has picked 5 COVID-19 vaccine candidates for what they're calling Operation Warp Speed. This aims to get a usable vaccine available to the public by January 2021. Not in time for my college football season, sadly. But having a vaccine a little more than a year after the virus was first diagnosed, is a very lofty goal and very impressive feat. We're going to talk about 4 pharmaceutical companies today who are in the race to become the first to create a usable vaccine for the consumers. 4 of the U.S.-based Moderna. We're going to talk about AstraZeneca, which is headquartered in the UK and is partnering with the University of Oxford. Novavax, a Maryland-based company, the German-based BioNTech, and its parent company, Pfizer. More than 100 organizations and companies are currently working on vaccines to prevent COVID-19. A senior Trump administration official said Monday that health officials anticipate potential coronavirus vaccine production should begin by the end of the summer. We're almost at the end of the summer, or at least halfway, but still, this is incredible. Earlier this year, a top WHO executive stated that Gilead Sciences' Remdesivir was the leading therapy targeting COVID-19. Remdesivir, of course, has now become the de facto standard of care for the novel coronavirus disease. So we do have a standard of care, but we still are susceptible to this disease. So we're going to first look at what Moderna has. Moderna has gained almost 30% in the last week after the biotech company said its potential coronavirus vaccine successfully produced neutralizing antibodies in all 45 patients tested in an early stage trial. Awesome, right? Moderna's messenger RNA, also called mRNA, COVID vaccine is called mRNA 1273. It is currently in phase 2 of clinical testing. This trial will enroll 600 healthy participants, each of whom will receive 2 doses of the vaccine, 28 days apart. The trial is testing the vaccine's safety, retrogeneticity, the dosage that begins to cause the expected side effects, and immunogenicity, the ability to trigger an immune response in the body. However, while phase 2 is still underway, Moderna has already finalized protocol for a phase 3 study of mRNA 1273, which it says should start in January. Again, we're kind of in the middle of the month, so I'm hoping that they'll be able to make their target. Moderna will collaborate with the National Institutes of Health to conduct this phase 3 trial, which will enroll about 30,000 participants in the U.S. The primary endpoint of the trial will be the prevention of systematic COVID-19 disease. Secondary endpoints include the prevention of infection by SARS-CoV-2 and the prevention of severe cases of COVID-19. The biotech plans to begin a phase 3 study of the vaccine in July. Moderna's mRNA 1273 was included in a select group of COVID-19 vaccine candidates that are part of the administration's Operation Warp Speed program. So Moderna's CEO is optimistic about the chances of success. He said in NBC interview recently that he believes the probability of mRNA 1273 is going to win the approval from the U.S. Food and Drug Administration is between 80 and 90%. So they're pretty confident that this is going to work. These are not statements that the CEO is making lightly. So keep an eye on Moderna over the next month. The second one I want to look at is AstraZeneca. AstraZeneca and Oxford University reportedly will release phase 1 data Monday on their coronavirus vaccine candidate. The early reports suggest a strong antibody response, as well as killer T-cell production in healthy adults. A phase 3 trial is already underway. They are slightly ahead of Moderna, so keep that in mind. Their stock leapt 14% last week, blasting through a buy zone on those coronavirus vaccine report. Moderna's stock erupted for a 51.5% gain last week, also roaring past a buy zone, after giving some preliminary phase 1 data on the coronavirus vaccine. Monday's release will demonstrate whether the potential vaccine is safe and whether or not it triggers an immune response. Earlier this month, the vaccine developers said they were encouraged by the immune response they had seen in trials so far. So this is really good news. The vaccine candidate is already in large-scale phase 3 human trials to assess whether it can protect against COVID-19. AstraZeneca has, in recent weeks, signed supply chain agreements for the capacity to produce 2 billion doses of its vaccine candidate. The British drug maker has inked supply deals with the U.S. and the European Union countries. So this is huge. Shares have jumped 53% since mid-March as AstraZeneca joined the list of companies that are part of the Operation Warp Speed. Despite the recent rally, the $61.67 average analyst price target still puts the potential upside at 6.3% in the coming 12 months. However, before we break out the champagne, investors really need to be wary of going all in on AstraZeneca. We don't know if they're going to be the winner of the COVID vaccine race, just because they're in the lead right now. I think everyone's probably familiar with the parable of the tortoise and the hare, so we don't know who's going to win this. Nearly 150 COVID vaccine candidates are currently being researched. 17 are in clinical trials, with more on the way. So it's impossible to know which, if any, of these experimental vaccines will be successful. It's not over the question, and hopefully it's likely that multiple drug makers will eventually win regulatory approvals for their COVID-19 vaccine. So hopefully we're going to have a choice of what vaccine we want. In my opinion, though, the biggest winners from an investing perspective could be the small biotech stocks in the race. We're going to look at Novavax and BioNTech. Novavax has a phase 1/2 clinical study underway for its vaccine candidate. AstraZeneca claims a market cap of nearly $70 billion, and success for its vaccine would be a major catalyst for AstraZeneca stocks, but success for a small drug maker like Novavax and BioNTech would almost certainly be transformational for either company. So I encourage you to really look into these stocks. Novavax has, like I said, its phase 1/2 clinical study underway. Its shares are up close to 2,700% year to date. They initiated their study back in late May, and it plans to announce preliminary results from the phase 1 portion of the study later this month. Novavax ranks as the winner so far in securing funding for the program. Listen to this. Listen to how much money they have right now. The Coalition for Epidemic Preparedness Innovations awarded them up to $388 million for the development and production of their vaccine. They won a $60 million contract with the U.S. Department of Defense, and most importantly, it's receiving $1.6 billion in funding from Operation Warp Speed. So, if anyone is well funded to continue this trial, it's going to be these people right here, our Novavax. Our other small biotech firm is BioNTech, and they're partnered with Pfizer. So they've got a pretty solid older brother here that's going to be helping. They are coming up with a vaccine, but their candidate hasn't advanced beyond the preclinical testing yet. So that could be a problem. The company announced on May 20th that it selected its lead coronavirus vaccine candidate and signed deals with Emergent Biosolutions and Kindred Biosciences to manufacture the vaccine. It hopes to begin a phase 1 study this year, possibly before the end of summer. But again, we're halfway through the summer, so let's be a little skeptical about this. From a public policy standpoint, this is great news. Things could go back to normal next year, and I could see Alabama have another run at a national championship. So let's keep our fingers crossed that these vaccines work. This is a way to play, but, you know, I like to see these smaller firms because I really think that for a lower risk investor, it's a great way to play around in what's usually a market risk averse investors are likely to avoid. So I'm going to encourage you over the next month to watch these smaller biotech firms, and let's see what they're doing, and let's analyze it and see if they're pretty good investments. Right now, I'm going to take another brief break. When we come back, I'm going to share my top 10 personal finance apps. You will not want to miss this.
Tired of searching the vast jungle of podcasts? Now listen close and hear this out. There's a podcast network that covers just about everything that you've been searching. Hey! The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter, and download us on iTunes, SoundCloud, and Google Play.
Until one of the companies that we discussed in the last segment comes with a vaccine, I think most of us are going to be stuck at home. As I said earlier, since the pandemic started, I've been using my phone and my tablet more than ever. Although I usually reach for my phone to see what's trending on Twitter or if my mom got my last text message, we all know there's more to explore on our smartphones. Since I do have my phone within arm's reach 24 hours a day, 7 days a week, it's time to use the unlimited possibilities of my phone to clean out my financial junk drawer. And I really think that the easiest way to do that is with an app. So here are my top 10 personal finance apps. At number 10, I've got Digit Savings and Debt Manager. Digit is kind of cool because it's a real-time savings monitor. Digit's algorithm analyzes 4 things: your checking account balance, your upcoming income, including paycheck and or predicted irregular income, upcoming bills, and recent spending. That information is analyzed every day. So, if Digit can safely pull money from your linked checking account, the app will put it in a Digit account. Digit will skim funds off the top of your charges without you even noticing. The money pulled from your checking account will go into your Digit account or your rainy day fund. There's no minimum balance for that account, and you can withdraw from it whenever you want. My favorite feature of this app is that it provides overdraft protection. It allows you to provided that you keep a minimum balance in your account. If you dip below the minimum balance, Digit will pull the money from your rainy day fund, which I think is great. And if for some reason Digit saves too much and you get stuck with an overdraft fee, Digit will reimburse you. So that's a win-win. You're saving money with absolutely no consequences. Number 9, I've got the YNAB app. And YNAB stands for You Need a Budget. No, seriously, you do. As much as I would like to spend all of my money on Starbucks' latest Frappuccino flavors, that's not the best for my bottom line in any way that you can interpret that sentence. This app requires a little investment to get started. It's either $84 a year or $11.99 a month after a 30-day free trial. Students who provide proof of enrollment get an additional 12 months free. So this app is great for students who are just going off to college or working in high school and really need to understand how to budget their money. Those who pay this price, or students, can benefit from YNAB's many features. You can connect your bank accounts, set goals, contribute to saving, customize your spending categories. You can also access resources like app user guides, budgeting advice, and free workshop. This app is based on zero-based budgeting, which means every dollar has a job. So you basically create buckets of cash for specific uses, but every dollar has a function in this model. So it's pretty easy to follow, but it also is very precise. So number 8 is Albert for savings and investing. Albert is a free app, and he works by analyzing your spending and then automatically pulling money from your checking account into an Albert savings account. It's a lot like Digit, but your money is safe in your Albert savings account because it is an FDIC insured bank. So that gives you a little bit more peace of mind. It doesn't really tell you which bank it's using for your savings, but you've got the FDIC insurance that covers you up to $250,000. The downside to that is that it doesn't offer interest, but you can easily transfer. So that's really a way that you can get around the savings issue, is that you can open it up and you can transfer your money from your Albert app to an interest-based savings account. If you choose to leave your money in the Albert savings account, it does offer users monthly what they call bonuses. If you're a regular app user, you get 25 cents on every $100 you have on your account. The app also has a Genius service, which provides financial advice but costs a minimum of $4 a month for subscription. But you get access to a team of licensed investment advisors. You can ask them questions via text about a whole wide range of topics, including how to invest, retirement plans, insurance, and other budgeting. Number 7 is Personal Capital. It's a wealth tracking and spending app. Personal Capital is a free investment management service that combines the algorithm used by robo-advisors with access to human financial advisors. That seems like a pretty good win-win to me. While Personal Capital is primarily an investment tool, its free app includes features helpful for budgeters looking to track their spending. You can connect and monitor your checking, savings, and credit card accounts, as well as your IRAs, 401ks, mortgages, and loans. The app provides a spending snapshot by listing your recent transactions by category. You are able to customize those categories and see the percentage of total monthly spending in that category. Personal Capital also serves up a net worth tracker and portfolio breakdown. It's probably the most advanced financial tool that I have on this list, but if you already have a decent portfolio, this may be the best app for you. Number 6, Clarity Money. Clarity Money is an all-inclusive budgeting app. Users can link financial accounts from thousands of institutions, organizations, and track their expenses, spending, and bucket their spending into different categories. There are other features too, like subscription canceling and credit service monitoring. I find that this is pretty helpful because I am one of those people who will do the free trial of Stars, and I'll still be paying for it long after I finish season 5 of Outlander. Number 5 is Empower. Use Empower if you need help with savings. Maybe during the pandemic you've developed a little bit of an Amazon habit. This can put you back on track. It's a great app to help you with budgeting and saving. With Empower, you set up categories and input your spending limits. So then it will automatically monitor your spending, displaying your progress towards reaching that limit. That can help you determine where you need to pull back on your spending to make sure you stay on track. As you budget and spend, Empower monitors your finances and can automatically save money where you can afford it through automated savings feature. If you need expert tips, Empower will help you with that as well, giving you access to a human coach who can work one-on-one with you to help you improve your financial health, which is great and very convenient. Number 4 is Pocket Guard. Pocket Guard boils budgeting down to the only things many users want to know: how much they have for spending. It crunches the numbers to show how much money is available for accounting for bills, spending, and savings goal contribution. All users can view is how much money they have in their pocket for the day, week, or month. Those who want to dial down farther can track certain categories of spending like groceries, clothing, or eating out. Number 3 is Toshal. Toshal is a manual budgeting and spend tracking app. I think it has a beautiful design and is really intuitive. As far as a no-strings-attached budgeting and spend tracking app, this Toshal is one of the best out there. It's simple. Once you create an account, you can immediately begin recording income and your expenses and set a monthly spending limit. Toshal does not link to your bank account and automatically grab debit or credit card transactions. You are the one who has to put everything in. So depending on your philosophy, that's either a deal breaker or a selling point. A lot of people don't like the idea of giving third-party programs access to your banking logins, which I can absolutely sympathize with that. I'm okay and I personally trust them, but some users have found getting programs to sync up with multiple bank accounts and keep them current to be a challenge. So that's why where Toshal, I think, has an advantage. Your basic subscription is free. For $19.95 per year, you get additional features like the ability to export your data to Excel, PDF, or Google Docs. Number 2, we have Money Patrol. Use Money Patrol if you want a data-driven approach to your finances. Money Patrol is the best app for that. It monitors your financial accounts and delivers the information right back to you, giving you insight into how you're spending money on a daily basis. The best thing is that Money Patrol delivers its advice to you in a visually appealing format. You'll get charts and graphs along with tables that show your most recent transactions. And y'all know, I love some graphs. It helps me visualize and understand everything. You can pull reports and filter data by factors like category and retailer. I love this because I can tell which retailer I'm using most, where I'm spending too much money, and where I can pull money from my budget. The nice thing with Money Patrol is you don't even have to log in to monitor your spending. You actually get alerts when there's unusual activity on your on your account. Once you set up your monthly budget, the app will also notify you as you go over your spending limit in a particular category. The cool thing about this is as the app gets to know you better, your notifications will become more tailored to your regular habits. So this is really a high-tech, nice app that will kind of slap your wrist when you are doing a little too much online shopping. So my number 1 app is Mint. Mint, you've probably heard of, and it is the mother of all budgeting apps. You get personal capital tracking, wealth, and spending. It's been around forever, and it's still growing strong. Best of all, it is totally and completely free. With Mint, you can see all of your accounts in one place, including investment accounts, and it will categorize all your transactions automatically so you can keep track of your spending. Over time, Mint will give you your average spending amounts in each category to get you started on a realistic budget. One of my biggest problems is these one-size-fits-all savings, saying that you should save 20% of your income without even looking at what your budget is. Mint doesn't really do that. They're going to look at what you're spending, what you've got coming in, and how that's working for you before they even give you any recommendations. So a realistic budget is one that you'll stick to. You can set up bill reminders, and you'll get alerts if your cash gets too low or your credit card balances get too high. Here's where Mint is really smart. Mint will securely sync with your information from multiple financial institutions to give you a complete picture of how much you spent and what you spent it on. Mint will help you track categories to your purchases and track how much money is going. After you create your account, you simply connect your banks, credit cards, and bills. Any U.S., pretty much, I don't want to say all, but pretty much all U.S.-based banks will work. You can even use your small local credit union. You can additionally add any of your monthly bills or credit card information. Mint also helps you track your loans, student loans, mortgage, car notes, whatever other loans you may have out there, as well as your investment accounts like IRAs, in order to help you analyze your spending the best way possible. Mint will go back and pull several months of data from your accounts to get you a good idea of how you're trending. Mint will then use your spending data to make recommendations on how to help you save money. This is how they make their money. So listen to how slick this is. So if, for instance, you're paying an 18% interest on a credit card, so Mint will see this, and they can recommend a new credit card that has a balance transfer offer. And then they get paid the referral fee. So you win, they win, and everybody's happy. Mint also has an online budgeting review, and you can open up each transaction that you have and specify the category that you want, make notes, tag it, exclude it from your budget, and just whatever else you want to do. It's really personal. It's really interactive. If the budgeting and expense tracking sounds tedious, it's really only as complex as you make it. Mint will help you set and establish financial goals. So if you want to save for a house, a new car, a new marriage, you can set a goal for that and track your progress. So unless you have unlimited resources and you have so much money that it feels like everything is free, any of these, you really need to have a budget. And honestly, any of these apps will help. It's a matter of personal preference. So what I would advise you to do is take a look at these apps and figure out which one's the best for you. Now, once you have money in your account, then we need to talk about investing. Join me next time when my top 10 will be the top 10 investment apps. Once again, that's the end of my show. So once again, I want to thank you for joining me today. I hope you learned something. Thank you so much for listening to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I would like to ask you to please remember to subscribe to the show and write us a nice review. That will really help us. Also, please follow us on Facebook, Twitter, and Instagram. Thank you, and have a good night until we meet again.
You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.